Did take me a long time to believe that, when you're off Wall Street, when you're just like a retail investor like I was, you always think, there's no way they could be missing this, right? Like you have Wall Street. It's a $1 trillion institution, tens of thousands of analysts and hedge fund managers and all these people, hundreds of thousands of them around the world. How do they not see what I see?
If you're like me, you're a hardcore lemonade investor, hardcore lemonade researcher, hardcore lemonade bull, you might be thinking, why doesn't the market at large, why doesn't institutional investors at large, why doesn't Wall Street at large really get the lemonade story or seem to buy into the lemonade story? Why aren't they getting it? Why aren't they picking up on it? You might be wondering these same questions, and I want to give a few answers, partly from interviews, clips, and my own take on this of why Wall Street doesn't get the lemonade story yet.
And it took me a while to realize that they don't see most things. Okay. Like, because the noise is insane.
Don't want to, depart from the norm. They don't want to take these extra risks. Or how do you view kind of the whole we'll call it the Wall Street disadvantage. What is the Wall Street disadvantage here?
Okay. Let's start with the lifestyle, the workplace, the culture. You have to understand, and like I said, for 4 years, I lived this life with them. They get up, they get on a train, they get to the city, they're in an office building in Manhattan. There's CNBC playing in their lobby, right? They have 8 screens and herd mentality. They're in trading rooms with 300 traders. They hang out together, they go to lunch together, they have beers together. It's the disgusting herd mentality that's full of just noise, just so much noise. And the noise, it's literally like living every day inside of CNBC. That's what it is. It's just BS all day long. And they're all just watching the same news flow, right? And they all have their Bloomberg terminals, and they're all ingesting the same exact stuff, okay? Meanwhile, we are all over the place, right? We're all over the place. We are going to work all over the place. We're shopping everywhere. We're so engaged in the real world. We're so diverse. We're different colors. We're different ages. We're different cultures clashing in Discord groups, right? And all this stuff. And it's just like, that is, you have to have your foot deeply implanted in the real world to understand what's happening.
So first off, the noise level is insane. So what does he mean by that? He's saying, hey, in general, these Wall Street guys are all kind of feeding on the same information. They're all in this rush kind of panic mode to get the biggest opportunity and look the smartest and absorb the most information they possibly can. But the way he describes it, they're in this kind of tornado of information or information overload, and so many probably possible investment opportunities that are coming their way, so many possible things to kind of look at, but only on a surface or small, light level. And you really don't have the opportunity or chance to look deeper and really understand something at a deeper level. And if you look at Warren Buffett's example as an example of one of the greatest investors ever, he said, I don't even need to live in New York and be in that sort of chaos of extra added noise on Wall Street. I could just live in Omaha, Nebraska and do deeper research on companies and then invest big in my deepest convictions. To me, that makes way more sense than the amount of noise that Chris from Dumb Money is describing that the people on Wall Street are hearing. So number one, why does Wall Street not see an investment like Lemonade? It's the amount of noise that they're hearing. Then the next point he brings up is that they're a very monolithic group. So there is similar to sort of the amount of noise that's feeding them into this group and is feeding their own mindset. But it's this very monolithic group that kind of comes from a similar background, associates in the same places, eats in the same restaurants, mingles with the same people, reads the same news information sources. So this very monolithic group that doesn't spread out as much versus a retail investor community like us here in the Lemonade community, where there's people from all over the world, people from all different backgrounds, people from all different walks of life, people that are hardcore nerds just sitting in their basement, have no one to impress, that are deeply researching a company. It's a completely different kind of group of investors, and to my mind, a much more advantageous sort of situation or team or group of people researching and looking at something. So first off, those two reasons: the noise level is insane, and they're a much more monolithic group. That's why I think Wall Street's going to be a lot slower to catch on to an investment like Lemonade.
I'll give you the perfect example. You and everybody that watches your channel, you're one of the preeminent Tesla channels, right? If you're a big time Tesla investor and you've been a big time Tesla investor for the past 6, 7, 8 years, you're probably a social arb investor and you don't even know it, because you were able to see something very early in Tesla. Either you were driving a Tesla, you knew someone who had a Tesla, you experienced the product, and for whatever reason, you were able to see what was right in front of your face. Wall Street can never see big changes, ever. Never, ever, ever, right? Wall Street does not see big change. They don't believe it even when it's right in front of their face.
So this is a great quote. He said, Wall Street doesn't see big change even when it's right in front of their face. And so why don't they see that? I think the answer could be is because they're naturally going to be more skeptical. Naturally going to be more skeptical, especially of something that's a little bit uncertain, that's a little bit more into the future, that's a little bit not directly hard numbers right in front of you right now, that you a little bit more have to extrapolate on. They're going to be more skeptical. Could be naturally just the culture and thinking behind that, but I think it even comes from a deeper sort of reason of why there's that skepticism, is because most people and most organization structures, in my mind, they mistakenly overemphasize not making a mistake. So that is what gets incentivized, says, hey, don't screw up, don't change anything, don't step out of your boundary, don't try something new, because you might look like a fool to others. You might look like a fool to us, to our firm, to our company. So don't do that. Don't step out of these sort of safeguards and these bounds, because you might look like a fool. So don't make a mistake. Don't make a mistake. That's what this sort of screams at you. Don't make a mistake. And then they underemphasize the actual, hey, you did take something innovative, you did take a step that was brave, and you were successful, and now you have sort of a new innovative approach that could have significant improvements, or a new investment that you sort of jumped out and stood upon and said, hey, this is a great investment, and here's why. And then they underemphasize that kind of innovation. So in my mind, it's people in general, and this would be the same as what's the culture that's on Wall Street. They're afraid of sticking out, afraid of looking dumb, afraid of not looking the part or looking smart. They're afraid of making a mistake and looking like a fool. So it's too great of a personal risk, too great of a corporate risk to say, hey, we really think Lemonade's this brilliant company that could 50x, could 100x. That's a really brave thing to do when you have clients' money on the line, and you're not just talking about your own money, but there's clientele and there's other perspectives and there's other opinions sort of pushing at you to say, hey, why would you invest in something so risky and so unknown? So naturally, that leads to a culture that's skeptical, that says, I'm not really sure until it's right in front of me, because otherwise I don't want to take that kind of leap of faith. Because they're afraid of looking like a fool.
One of the reasons I don't know the answer is because it doesn't preoccupy me. I don't spend time on this. I haven't investigated it. It feels unimportant to me, and I don't mean, again, to sound dismissive. It's just I'm focused on managing the business, not managing what analysts think. But I think there's two or three dynamics at play. Specifically, our last earnings call turned out to be on a date that a few other major insurance companies were announcing concurrently. So analysts had to choose which call to attend, and there was some scheduling snafu in that regard. So it was underattended relative to what we usually see. I think that explains that specific data point that you mentioned. A second one is that there's been a shift in our coverage. So in the early days, we were covered predominantly by growth and tech analysts. And today we are covered predominantly by insurance analysts. And I think that lends them to be a bit skeptical, B, a bit unfamiliar with a lot of the things that we're trying to do and terms that we use and the way we're structuring our business. And that doesn't make them any less smart or invested in getting it right, but it does make them much more of a lean back, you kind of show me, prove it to me. I'll wait and see the results. And when I see it in the results, then I'll buy it kind of approach, which is a legitimate conservatism, but certainly doesn't accord with how we see the world or, by the sounds of things, how you do or some other investors do.
This is a great point by Daneil that he says, hey, the people following Lemonade from Wall Street analysts, well, they're insurance experts. They're not technology thinkers. Insurance experts, not technology thinkers. And insurance is this old industry where there's very old companies that have been around for literally hundreds of years, and very consistent industry that's probably had little change over the decades of time. And from my understanding, certainly very little technological change that would transform kind of the administrative efficiency of a company in insurance, or even the underwriting ability with the amount of digital kind of fingerprint nuanced data that they could collect. So you have these analysts that are not from that tech background whatsoever that are now following Lemonade and giving their take on Lemonade. So it's obvious you have that disconnect.
I think a third thing is the collapse of our stock price has made us less interesting to a lot of institutional investors. So I think they are deprioritizing Lemonade, and our story is, I like to think, compelling, but also nuanced and deep, and it's not just a template. Oh, I know 10 other insurance companies. This is an 11th. It requires some effort, particularly if you come from the world of insurance. And I just don't know that they feel that at the current market dynamics, it's worth spending all that much time on Lemonade.
And a final point of why Wall Street really doesn't get the Lemonade story yet is because the stock price is too cheap. This was from a Bank of America analyst note the other day. It was actually originally shared by Financial Controller on Twitter, or at least the first place I saw it. So definitely give him a follow if you're active on Twitter. But I kind of made fun of it, and I just retweeted this picture and said, the stock is too cheap, so we have to stop following. And they give some valid concerns or criticisms here, but sort of the main reason, or notice of this note says, hey, we're terminating coverage because the shares have fallen 46% in the last 12 months. The market cap is below 800 million. So it's really, they're basically saying it's not worth our time to cover the stock because the stock price is just too cheap. This is really funny to me because if you're actually following the details of the company, then this really represents the greatest opportunity when the company is at the lowest stock price. This is when you have the greatest margin of safety on your investment, and you have the biggest upside or possible upside. So again, it's funny to me. I get this answer, and I think it almost goes back to just the level of noise that Wall Street is, the average Wall Street analyst or investment firm is undertaking and is just around them. But it's funny to me that they basically say, hey, this is too much for us to analyze. So there's no point now because the company their price is so low. It would be like you wanting to go buy a house to live in and then going to a realtor, and the realtor's like, you know what? The market is just way too good right now. Like, it's for buyers, the prices are just too low. So we really stop paying attention to this market. And we're going to go look at this shinier, glitzier market over here in this other suburb or other city or other part of the nation entirely and say, hey, this is a bit more expensive. So we think you should look for your real estate needs over here.
The Wall Street analysts have changed beyond compare in the eyes of investors over the course of recent years because of what's known as Rule FD. So once upon a time, analysts had really privileged access to management and to data, and listening to what analysts said, the bank's analysts, the investor analysts, was a very smart thing to do because they knew more than you, Neil, would ever know about the company. A bunch of years ago, the law changed and companies are precluded from telling analysts anything material that they don't tell the whole world concurrently. And therefore, really, the notion that these analysts will have a better understanding of Lemonade than you will seems exceedingly unlikely to me. And I think they have been, there are people who track their buy and sell recommendations. I'm not talking about Lemonade, just in general. And you'll see that they have as a category, they have very poor track record ever since they lost their advantage play. And it's one of the reasons that not only I don't pay that much close attention, but I don't see it moving our stock. I don't see their buys and their sells mattering so much. In the early days, the Motley Fool came out with a few strong buy recommendations.
Yes, I remember.
About Lemonade. That moved our stock more than Goldman Sachs' analysts ever did. So I think that just gives you a sense of how the power has shifted within the world of kind of investor advisors, if you like.
And to kind of sum everything up in this video, I think us as retail investors do have a huge advantage to uncover investments like Lemonade much earlier than Wall Street and the rest of the investment world at large. That's because we don't have the same amount of insane noise. We can deep dive, focus on investments that we really think have potential. We don't have this surrounding noise around us. We're also not a monolithic group. We're a group of investors that come from all different backgrounds, from all over the world, all different ages, et cetera, not a monolithic group at all, but very, very diverse. We're also not as naturally skeptical. Of course, being skeptical in and of itself isn't a bad thing, but I think as a group we can be more open-minded to see something, hey, a big change that's coming, and have vision to kind of take those further leaps, to look out into the future that a typical analyst wouldn't be able to do, in part also because they're afraid of looking like a fool and wasting their customers or clients' money. They're afraid of losing that money more than they are of the sort of potential upside huge gains that would be there from taking somewhat of a less certain, in quotes, risk. And us as retail investors within the context of Lemonade have the advantage again because we do have insurance experts that are investing in Lemonade, but we're not just all insurance experts. We're from this diverse group of people that would have a much better chance of understanding a tech company and a tech story like Lemonade. And we also have the advantage as retail because we're willing to put the effort and time into investing in a company like Lemonade, even though the stock price is down, 90% from their all-time highs and is below, $800 million of market cap. So just because they've fallen off the radar of most people, we can still put the time and effort in and the detail in to track this closely. So it's really exciting because I think us as retail investors really have the advantage. We don't have all this other baggage, but we can research deep from many angles, and we find what we feel is a really, really excellent risk-reward opportunity, then we can invest big. At least that is my philosophy and my investing strategy. And if you made it this far in the video, I'll leave you with one anecdotal story. When I was at Investor Day in November 2022, I was talking with Shai, and I'm kind of paraphrasing my memories of the discussion him and I had. But he pointed out, he said, hey, you know what? I really think like what I'm doing, what we're doing, even in following Lemonade as a retail investing world, so much of the world in the investing world is going to move towards that. Like that's going to really get the best returns because they're people that can be, they're individuals that can be hardcore and really dive deep into a company. And they don't have all this other baggage like we've talked about in this video. So that's just a quick memory and paraphrase of a discussion I had with Shai, but I think again points to this fact that we really have the advantage, and it's so exciting as this Lemonade investor community grows. Thanks so much for watching, and remember, it's in the bag.